if energy really starts to get in trouble and stocks and bonds get into trouble, well, if I'm an investor, I'm going to go into silver and gold because they protect wealth. They're not based on energy being burned.
Please join us for our next live stream Sunday, October 24th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, October 24th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel or if you haven't already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support. Independent researcher Steve St Angelo, founder of the SRSRocco Report, joins us once again today. Steve considers studying the impact of the energy return on investment, or EROI, one of the most important aspects of his energy research, and the impact energy has on the mining industry, precious metals, paper assets, and the overall economy. For the past several years, he has written scholarly articles for some of the top precious metals and financial websites. It's time to saddle up and silver up for Steve St Angelo. Steve, welcome back to SBTV. How are you doing?
Doing great, Patrick. Lots happened. We're seeing some crazy things happening in the energy markets, which I've been kind of talking about for quite a while, and now we're starting to see the symptoms of what I call the energy cliff. So there's plenty to talk about today.
Steve, energy. Flip a switch and we expect the light to go on. Is this something we have taken for granted or something we may not even truly understand?
Yes, that's true. And the reason is because the energy is supplied to us. We have the economy, and this system is so specialized that there's people that deliver energy for us. So really the public is only concerned about two things: energy prices and then shortages. And if there's shortages, then there's high energy prices. And so that's the only thing that the public is concerned about. And so if there's the continued energy supply, they're happy. But now we're starting to see that that's the problem we're seeing not only in the UK and in Europe with natural gas. We're seeing that in China with coal. And so now we have that issue, and then the world has transitioned to what I call, this is my new economy. It's called the Amazon Star Trek replicator economy. And that's where people are at home, they're doing their work from home now, or they get off work and they go on the computer and they can buy whatever they want from Amazon, and they push a button, and within 2 days or a day or 2 days, it appears on their doorstep. And so with that kind of supply chain, it really makes you feel like you take it for granted. And Patrick, it takes a massive amount of energy to do all that. And we just don't see it. We take that for granted. So that's what we're used to. And unfortunately, I believe we're going to, that world is going to be in the rear view mirror in the next few years, unfortunately.
Yeah, okay. We'll touch on a few things you just said there. But recently, I believe you stated gold and especially silver will begin to behave more like U.S. treasuries than just-in-time commodities, and as they're currently being valued now today. Can you share with us your thoughts behind this?
Yeah, let's relate it to the natural gas market in Europe. If you go back to last year when we had the pandemic shutdowns, there was a lot less manufacturing. And so the natural gas inventories in Europe, they built up. And when you build up inventories, you need less natural gas. So the price of natural gas in Europe in May fell to a low of €3. Yesterday, it hit 160. So last year, this is what I call just-in-time inventory pricing. Last year, Europe took for granted natural gas. They were swimming in natural gas. You could almost give it away for free. Now, they're worried that they're going to freeze to death in Europe. So this is what's happened with natural gas. But what I see happening with gold and silver, treasuries are supposed to be the collateral, the kind of the safe haven. When there's a sell-off in the markets, people go into treasuries, bonds. That's what happens. Well, with the central banks now holding 30 trillion on their assets, on their balance sheets, and most of it's bonds and treasuries. It was only 5 trillion before the 2008 financial crisis. Now it's 30. And so the bonds now are not really good collateral anymore. That's why you're seeing the reverse repo market. The Fed have to do 1.5 trillion in reverse repo on a daily basis. So in time, what I see is right now, gold and silver are taken for granted, especially silver. So if you see lower silver prices, kind of think of, well, that's the way the Europeans were thinking of natural gas last year when it was only €3. Now they can't get enough of it, and now they're very concerned. Well, when the energy problem gets really bad, a lot of the 230 trillion in global bonds and stocks, and I'm not even including real estate, they're going to get into serious trouble, and that's when you're going to start seeing people move into silver and gold, and there's just not that much silver and gold to acquire. And that's why I see this mechanism moving from just-in-time inventory prices like commodities. That's the way silver's being right now. Silver's kind of out, but that's going to change in the future as more investors use the metals to protect wealth.
Okay. Steve, from a recent report from Reuters, the world's major oil producers have decided to keep a cap on crude supplies. And this is very reminiscent, to me at least, of the 70s, where we saw inflation move upwards just under 20%. Do you think with what's happening right now that we are going to see oil being a driver of inflation once again?
Yes, but differently. You see, what we don't realize, there was the Saudi oil price shock when they pulled off production in 74. Then there was the Iranian Revolution, and they pulled off production in 79. But still, oil production and consumption in the world increased 15 million barrels a day from 1970 to 1980, even though there was these fluctuations. And then since the 2009 financial crisis, global oil production has increased 14 million barrels a day. The difference is the debt. The debt in the 70s increased 4 trillion. The debt since 2009 is almost 100 trillion. What the world is facing now, Patrick, is we're trying to run the world at 100 million barrels of oil production a day. And oil is the main energy source that allows all other energy sources to work, such as coal and natural gas. Without oil, you can't produce as much coal and natural gas. So think about, this is the way I want people to think about this. If you're running a car at 50 miles an hour, you get excellent fuel mileage, 38, 40 miles a gallon, depending on the car. Now, move that up to 75 and then move that up to 100 miles an hour. And keep that car running on a highway or on an interstate out in the middle of nowhere, 100 miles an hour for hours. The only thing you can do is stop and get more fuel, and you get back on that interstate and you run 100 miles an hour. And just keep doing that for days and weeks and months. The car's going to fall apart. So the issue is we're trying to run the world at such high oil, natural gas, and coal rates. When there's a disruption, it becomes very volatile. And that's what we're at this energy cliff now. We're at the peak, and it's going to be very volatile. And again, the world is losing between 5 and 6 million barrels a day of production due to depletion. Every year, 5 to 6 million barrels a day. Basically, the world has to find a Saudi Arabia Ghawar field, which is the largest oil field in the world. It was 5 million barrels a day. You got to find one of those every day, every year. And you got to find it next year. You got to find it the year after. And we're not doing that. We're burning 4 barrels for every barrel we're finding. So this is the issue we're at now. And I think because we're using so much energy at such a high rate, it's very hard to continue doing that. And we're going to see higher oil prices because I don't think we're going to see that much more production growth like we did So that's the problem. We're not going to have another 10 million barrels a day of production growth in the next decade. We're not going to have that.
Okay, it's pretty interesting with what you're saying, because I remember just a year or two ago, the U.S. was oil independent, and I believe even was a leading oil producer, even exporting oil. And my whole life, we have been listening to the government saying we need oil independence, and it was achieved back then. And then poof, it's all gone, and so is that oil independence. What happened here, and why did you turn?
Well, it was mainly due to the pandemic shutdown. The decline in U.S. shale oil production, which was the reason the United States increased oil production, it peaked in 1970 at about 10 million barrels a day. That was conventional. And it had been slowly declining to about 5 by 2005. And then shale came on the picture, in 2008, 7 and 8. And so we ramped up shale production to 8.5 million barrels a day. It peaked, and then the pandemic shutdowns really put a monkey wrench in the shale oil industry. And so they had to pull off production. And then now that's the issue. It's the reduction in shale oil production. So in last year, right at the pandemic, we were exporting, the U.S. was a net exporter of oil for the first time, about 1.5 million barrels a day. Well, today we're now importing about 1.7 million barrels a day. And so that's the difference. It will fluctuate, but as U.S. oil production continues to decline, then we're going to see even more net imports of oil.
Okay, and is fracking still on the radar in the U.S.?
Yes, especially at these higher prices. We're seeing more drilling rigs, but the problem is that most of the growth for a few years is going to be in the Permian. But the other fields like the Bakken, the Eagle Ford, and the Niobrara, and those are the 4 major oil fields and the shale fields in the U.S. They've drilled most of the sweet spots out, and so what they're doing now, the whole industry is depleting these DUCs, drilled but uncompleted wells. They drilled them, but they never completed them. And the drilling is about a third, maybe 40% the cost, and then 60% is completing it. So they had a huge inventory, over like 7,000 of these DUCs. So they're using these up over the last year now, and so it's kept their capex lower. And so now this is what they're doing. And there's another issue, Patrick. To produce this oil, the industry had 12 billion barrels of wastewater in 2019. And that's going to increase if we want to ramp up more oil production. And so the problem is getting rid of this. Some of this is recycled, most of it is not, and it's injected deep into the ground. And now we're seeing more earthquake activity around the Permian, where a lot of this is injected deep into the ground. And another thing, New Mexico is it's one of the second driest states in the country. They're looking to put limits on water consumption, because each shale well consumes 11 million barrels of water. And so that's the problem. And so when you add all these up, it's just amazing what we're trying to do to keep this oil production up. And so even though we're going to see maybe some growth in the Permian, we're going to be seeing, I look at U.S. oil production to decline 75% between 2030 and 2035. And that's going to be a much different place for the United States.
Yeah, I can imagine that. I mean, that puts us right back on almost a complete dependence on oil.
Yeah,
Or
because
foreign oil.
yeah, in 2005, we consumed 20 million barrels a day. We produced 5. We were importing 75%. Just last year, we didn't, well, we're still importing oil. Don't get me wrong, because, what's interesting, we're exporting a lot of this shale oil because we can't use it. So we're exporting it to Asia and to other countries because it's very light oil. We need more of a medium. The Gulf refineries and the Gulf Coast are designed for medium oil, not light oil. So we're taking the tar sands, the oil sands, we're mixing it with the shale oil to make this Frankenstein crude that's very problematic in the refineries to make something of it. But we are still importing oil. But I think, yes, if once we see U.S. production really start to decline by 2025 and 2030, and then it's really going to fall off after 2030, the United States is going to be in serious trouble because the rest of the world is going to be also declining in oil production. So we're not going to be able to import the 15 million barrels a day that we were in 2005.
And along with that, a lack of mine investment reflecting pressure from socially conscious investors, import constraints due to coronavirus restrictions, and a surge in natural gas prices, as you talked about, amid prospects of shortages in inventories, especially in Europe, which you touched on. Are these the reasons for the energy problems on our doorstep, in your opinion? Or what do you think is the cause of this?
Those are the superficial reasons. If you're really a sick person, you just catch a cold and it could do you in. So, as I mentioned, the world is running at 100 miles per hour. That's what it is. 100. That's what it was in 2019. 100 million barrels a day of oil production, total liquids. That's everything. Same thing with natural gas. Natural gas is very high, and so coal production is very high. To do that, it takes a massive amount of energy to continue doing that and to replace what is being lost. And that's the major problem. And so when you have issues like a very cold winter in Europe and in Russia, then you decided, well, we're going to ramp up green energy. So we're going to get rid of coal, and then you're going to replace it with natural gas. Well, then you have to have natural gas inventories. And I call these just-in-time natural gas inventories because it's much more difficult to have larger inventories of natural gas than coal, because coal is right next to the power plant. These natural gas inventories, LNG has to be imported from the United States or piped in from Russia. And then on top of it, you had lousy performance from European wind and solar. So when you add those all together, Europe had very low natural gas inventories by April this year, March, April, and Russia was even worse than Europe. They were at 19%. And normally they're no lower than 30. Russia got down to 19%. So this idea that Russia is holding off natural gas to Europe is not right, because Russia is trying. They got to take care of themselves first. They're trying to build up their inventories, and so this is the reason why you're seeing very high prices in Europe, because their inventories are still very low. They're not prepared for winter, and they're kind of scrambling. So when you put this all together, I think this is a symptom of we're reaching the energy cliff, and then it's going to be just extremely volatile as time goes on.
Okay, and then we have also China, which is in a different league because they do use coal for their power plants, and they're actually having power shortages. And in a recent report from Bloomberg, we're hearing more than half of China's mainland provinces are limiting electricity use. Why can't China meet their country's demands with coal for their power plants?
Well, that's about a 20, 30-minute answer right there. And it goes back to the Communist Chinese Party switching more to capitalism, and now they're trying to switch back more to socialism. And so in doing that, they're kind of allowing their part of their economy to falter so that it can turn to be more socialistic. And so right now, the power plants are run by the Communist Chinese Party. And so they've been regulating the price of power so they can continue to run their manufacturing economy and keep energy prices low. But coal prices have shot up. So now they're at this problem. And the issue is too, that's another superficial problem, because you know what the real problem is, Patrick? China has grown too large and too quickly. It's massive now. And then they have these gargantuan water diversion projects because they don't have enough water up north in Beijing, and it's drier up there. So what certain countries have done to redirect water, they have taken it on a massive scale. And I think in their East Coast diversion project, which is moving water up to Beijing, it has to go up these mountains. And that takes a lot of energy to pump water up these mountains. China has all these massive dams, all these huge cities and infrastructure that it now has to, it just consumes a massive amount of energy. And so this is the problem that China is at. And they have to continue running their system at this high level. And all these other issues are getting in the way. And I think that's just going to get worse as time goes on as well.
Currently, we know there's a chip shortage, a car parts shortage. If China cannot keep the lights on, let's say, at the factories, does this then become a very real possibility that much of the world goes dark, in a sense where supplies that are already in a weak global supply chain will become weaker?
Not like, I don't think so. What's happening in China, they're going to have issues with it, but I don't see it really moving to other parts of the world on a large scale. Not yet. But what is going to happen, the market and the economy is going to suffer from what I call these wide fluctuations of high and low energy prices. And then we're going to have shortages and surpluses, and then we're going to have recessions, and then it's going to turn into an ongoing depression as oil production really starts to fall. Because oil allows everything else to work. Without oil, you don't have coal, you don't have natural gas, you can't do wind, you can't do solar, you can't do geothermal, you can't do nuclear. Because a lot of you can't make a wind turbine or a solar panel or a nuclear power plant from a Star Trek replicator. It has to be done the old-fashioned way. And that takes a massive amount of fossil fuels. So if oil gets into trouble, everything else does. And so I think we're starting to see the problems. We're starting to see the symptoms. But then when you go into shortage and high prices, Patrick, you come back into a surplus and low prices and then a recession. And it could be a deep recession. And so this is how it's going to be for a little while before we really start to lose oil production. And so that's how I see this process working out.
Okay. And I'm just asking these questions because we're seeing some reports coming out of China that are saying power plants have simply stopped running because they're operating at a loss. Is this something that could be a global phenomena where power plants simply shut down? I mean, you yourself sort of had an experience like this in your article that you wrote, Internet and Phone Out of Service, the Shape of Things to Come.
Yes. Now, what is happening in China and even in the UK, right? Because we're hearing about they're having fuel shortages. They have to have the military now try to help move fuel to fuel stations in the UK. And then there's food shortages. Why? Because it takes fertilizer to grow food, and you need natural gas to make fertilizer, as well as other things. But natural gas is a main component of the fertilizer. So when you start putting it all together, things get into trouble. So yes, what's happening in China and in the UK, that will happen throughout the world. It's just going to take time. And so basically, we have built up such a high level of production of goods that we need such a high level of energy. And this is the problem we're at now. We have built this huge system that has to run at 100 miles an hour. And if you start going below that, the tires get a little warm, or things start to, the red light goes on, the engine's running too warm. Then it goes down to 90 miles an hour, 95, 90. This is the problem. I mean, it's just, there's a picture that I used in one of my presentations. To supply the coal to China, one of the supplies is coming from Mongolia. It looks like a train, but it's not. It's miles long coal trucks, miles long coal trucks, all next to each other. And this is how China is trying to continue to feed its coal. And yeah, that's the problem. We're running at such a high level of energy. This is going to be a problem in the future for more and more countries and continents as time goes on.
Okay, and speaking of that coal, it takes me back to a recent tweet that you had posted where you had tweeted out, with China producing a record 2.1 billion tons of coal, 1H 2021, first half of 2021. There's no secret who's responsible. Anyhow, green energy isn't green and it isn't renewable. So maybe we should try plan B, manage degrowth instead. Can you expand on this tweet a bit?
Yes, to get an idea of how much coal China produces, because you hear there's a lot of, about the global warming and climate change. And so you hear a lot of attacking of Europe and Germany and these other, in the United States. We need to cut the coal, and they are cutting the coal. But the elephant in the room is China. China consumes about 4 billion metric tons of coal a year. 4 billion. The United States last year consumed a little less than 500 million tons. So the United States would have to burn, produce, and consume 8 times to equal what China did. And so the idea that China is pulling back, they did, I think, 3.9 billion tons last year. They did 2.1 billion in the first half. So if they do the same in the second half, that's simple math. That's 4.2. They're not cutting back. They're doing more. So that's the problem. Is China is so reliant on coal, and get this, if the reserves in the world, Patrick, run between about 400 years to 300 years on several countries, the United States. They say, well, if you look at the coal reserves and then you see how much production a year, a lot of the major producers are, have a lot of coal. And so I think the United States has like 300 years. But you know what China has? 37. Because they're consuming 4 billion tons a year. And so those reserves are not realistic to me, but that just goes to show you how bad the situation is. And about the managed degrowth, I'm glad you asked that question, because I read this 511-page report from the Finland Geological Survey of Finland, and I want to just read this to you. It's about the oil, a critical raw material. It says, and I'm going to just a summary, the implications of this report suggest that with the depletion and unreliability in supply of oil, our industrial ecosystem would be required to evolve into a lower energy consumption profile with less complexity. I've been talking about that. A collapse of complex societies, as Joseph Tainter has written about. We need to become less complex. We can't go into more high tech. We got to do less high tech. And then it goes on to say, as there is no real replacement for oil in terms of what it contributes, this necessitates a complete restructure of the demand side of the energy requirements. This has far-reaching implications in the structure of the industrial ecosystem. So, and then it concludes by saying, currently our industrial ecosystem is highly dependent on a finite, non-renewable sources of oil, natural gas, and coal. This report shows that the peak date is either imminent or is in recent past, which is in 2018. And so it's a 511-page document. It's amazing what's in there. And again, when you're running the world at 100 miles an hour, you are devouring so much of the energy to run it. At some point in time, we're going to start having that collapse. I call it the Seneca Cliff. And that report just puts all the details in order. And that's what we're facing, unfortunately.
Steve, coal futures continue to rise or break records, and last I checked, we were at some $240 per metric ton, gaining some 28% in September. If this continues, with not just the coal prices, but also fuel prices continuing to rise, how is this going to affect the gold and silver miners?
Well, it's going to affect the cost of production, right? Now, unless miners have long-term energy contracts, and smart ones do, they arrange it with the government or with the local energy company, and they have long-term contracts. And so a lot of the times these big prices swings that we're seeing, that's the spot price. So if you're lucky and you locked in a long-term contract, that's you're going to get the regular rate. But let's forget just the energy. Now, some companies probably didn't do that as much, but it's you see, when energy goes up, what goes up with it? Material prices, equipment prices, and then labor. Right? We're hearing labor costs go up because everything's going up. So even though if you say, well, we've got a nice energy contract at a nice price, other things are going up. You're going to pay more for materials that you need and equipment and labor. And so this is the increase in the oil price has been the leading driver in the price of the precious metals during the 1970s and in the 2000s. And if we continue to see much higher oil prices and energy prices, it's going to finally hit in the miners. And so I think that's a positive sign. But unfortunately, if we do see lower commodity prices, then these higher costs are going to impact the miners. And so I think that might be a short-term thing, but that's something we also have to keep an eye on too.
You also fairly recently wrote an article titled Setting the Stage for Much Higher Silver Prices, the Energy Crunch and Skyrocketing Silver Investment Demand. With higher energy costs, are we going to see money start moving from equities and bonds into precious metals and perhaps even particularly silver?
Well, this is what makes logical sense to me, because a natural gas futures contract is not natural gas. Even though you buy the natural gas, you buy the futures contract to get the natural gas. You need the natural gas. You could care less about the contract. You need the real thing. So this is the problem. When you have problems with energy, then the bonds and the stocks get into trouble, and real estate. And we haven't even seen that yet. Now, we could have hyperinflation, but then who cares? Because hyperinflations don't last long. Now, the reason why I said that, I did some research, and there's about a little more than 2 billion ounces of public investment silver. When I say public, that's LBMA, that's on the exchange and the ETFs. And since about 2000, there's been about 3 billion ounces of private silver investment, and that's coins and bars. And about 818 million ounces of that number is silver eagles and maples. Now, if I'm a European energy company, I'm going to go on the futures market to buy natural gas because I really need that natural gas now, because I got customers who I don't want to freeze to death. Well, if energy really starts to get in trouble and stocks and bonds get into trouble, well, if I'm an investor, I want to protect. I'm going to go into silver and gold because they protect wealth. They're not based on energy being burned. Well, the issue is there's only 50 billion worth of public investment silver that they can get. Because if I own silver eagles and they go up to $50 and I say, I'm going to sell for you, well, a large company, a large financial institution isn't going to buy my 20 silver eagles just as much as a energy company in the UK is not going to go to a retail store and buy a 20-gallon LPG tank. That's ridiculous. They got to buy large wholesale numbers. So what I see happening, and a lot of the people in the precious metal community continue to berate the ETFs like the iShares, and they call it a fraud. Now that's fine. But when JP Morgan came out and changed their prospectus and said that after the Wall Street silver surge back in February, they said we might, if we cannot access the silver, then we want to warn people. Well, if they can produce all the paper silver bars, they wouldn't say that. So the thing is, when large institutions, financial institutions, and large investors start to understand what's happening with the energy and how it's going to negatively impact stocks and bonds, they're going to move into silver. And all they can get They're not going to knock on someone's door and ask for their 20 silver eagles. They're going to go on the open market, just like they're doing in Europe for natural gas. And that's when you're going to see the silver price move up. That to me is the first big move is going to happen with the large institutions and investors. And then after that, it will translate into physical buying. But so that's how I see this working out in the future. And unfortunately, I think a lot of people in the precious metal community don't understand that dynamic.
That's a great point there again. Steve, you're always in tune and in step with the miners, and I know that you do run a paid membership. But what can you tell us about the health of the miners, particularly the silver miners?
Yeah, I recently did a gold member subscriber video presentation detailed about Fortuna Silver. It's one of my favorites, and I think it's going to do very well. That's due to the fundamentals. And the issue about the silver miners is this: there's two sides to this equation. If we're going to see higher silver prices, which we are, then it's good to be in a silver miner. Because let's say you can't get silver. Well, if you want, then let's say for whatever reason it's hard to get silver, either retail or even ETF, it's hard to get it. Well, you could go into the miner. Well, there's only so many shares. So you could really see the price of these miners increase. And I really think that's going to happen. But I don't think we're at a cycle low yet in the mining stocks, unfortunately, because I still think we're going to see a sell-off in the broader markets. And so I don't think we have seen a cycle low yet in the mining stocks. But I think they're going to be excellent investments, but you also have to be concerned about what happens if there are global supply chain disruptions. And the mines either can't get some energy, it's hard for them to get some materials, they can't get some equipment. This we have to figure in as well, because that could impact production levels. So again, miners are very risky, but they could be very wonderful investments. But I think those are speculations where people should put a small percentage of their funds, where it's very important that people invest in physical metals. That to me is the real store of value.
All right, great point again. Steve, last question here. Is energy, the lack or abundance of energy, meaning shortages and gluts, the price of energy, the supply of energy, the need and ever-growing need for energy, is this something that can bring economies to collapse, render currencies worthless, bring out the populist pitchforks, and even take nations to war? And if so, why do we not value or understand the EROI, or the energy return on investment?
Well, it's very simple. There's a lot of very intelligent people in the world, but they're so specialized, they don't tend to look at this. And so I hear a lot of, we got plenty of coal, we've got plenty of natural gas. We got natural gas to last us 100 years. Well, it takes 1,500 semi-tractor trailers just to frack one natural gas shale well. So you don't have 100 years of natural gas if you don't have the oil to run the trucks to drill and complete that well. And then you've got to transport all the water, and they say, well, we just use natural gas liquid natural gas to run the trucks. Well, now you're cutting into the electric generation. There's all these, people have all these quick, off the cuff, replies. Oh, we're going to be fine. You're not going to be fine. We're starting to see it right now. And so it all comes down to the falling energy return on investment. And I knew that was the problem that we were facing, looking at the falling energy return on investment since the 1930s. The U.S. had 100-to-1 energy return on investment of oil in the 1930s, and we've gone all the way down to shale oil, which is 5-to-1. And it's just very hard to run an economy on 5-to-1. And I learned that it's always been the energy return on investment because I did the research on the collapse of the late Bronze Age in 1200 BC and the collapse of Rome, 400 AD, plus or minus, and all of them were due to the falling energy return on investment of wood fuel. Because I had no idea, and my estimate is that both of them, maybe more the ancient Roman Empire, they cut down during their peak years, let's say 50 to 75 years. They cut down 1 billion trees to smelt their silver and lead and copper and iron and then they have to build ships, and then they have to feed all these people. They have to use, they made millions of loaves of bread, and that all took wood. And then you have to build construction, and then the wars. All this consumed a massive amount of wood. And they went through the easy to get wood. Yes, trees regrow, but good trees take a long time to regrow. And unfortunately, that's the reason why the Romans went up into the Germanic area, because they had the good trees, because they had gone through a lot of their trees in the southern part of the Roman Empire. So that's what it all comes down to, the falling energy return on investment. Even though you could say it was a lot of problems with the Roman Empire, debasement of the currency. And I've mentioned, this is the last thing I'll say. The reason why they debased the silver denarius was because they reached peak silver production. And why did they reach peak silver production? Because they reached peak wood energy return on investment. They didn't run out of silver ore. They ran out of easy to access wood to turn into charcoal to smelt lead and silver. So to keep business going, they debased the currency. And that's what we're doing now. Same thing. Nothing's changed, except we have oil is a lot better than wood. You can do a lot more with oil. And so that's why we have this high-tech system. And so that's where we're at now, Patrick. And unfortunately, the falling energy return on investment, there's nothing you can do to stop that. It just gets worse every year. And so we're seeing this massive debt, and that's being used to prop the system up to continue business as usual for another year. But at some point in time, the whole thing starts to fall apart. One more thing too, when you look at the ancient Greek and Mediterranean civilizations, and people go on vacation, and you see these structures made of granite, and these beautiful buildings that are still there, and they're on these desolate, dry. Some places have very little vegetation. Well, you see, that wasn't always the way. That island was green with trees. But because the Mediterranean is very arid, when you cut down the trees and screw up the system and the topsoil after so much rain, you basically turn it into a sterile place. And so there's no coincidence that the collapse of these ancient civilizations, and you could still see a lot of these structures, the landscape behind it is a very dry, arid, almost desert-like, rocky-looking environment. And there's no coincidence. And that's exactly what we're doing today.
So Steve St Angelo, before we wrap up, can you let the viewers know where they can find your website, and of course where they can find you on Twitter and your YouTube channel?
You can learn more about the SRSRocco Report if you go to the SRSRocReport.com. We do have free member articles. I used to have to sign up, but now there's no sign up necessary. And we put out silver and gold member content that I think, Patrick, you can't find this information anywhere else. I look at all these different areas, and I try to make it easy for people to understand. And I also have the SRSRocco Report YouTube channel. I just put out a new video at the SRSRocco Report YouTube channel, and it helps reconnect people with the energy dots that we have taken for granted. And when you understand the energy dots, then you understand why it's important to invest in precious metals, and why it's important to start to take more responsibility of your life. And unfortunately, politicians are not going to be able to help us in the future. It's going to be up to individuals and families and local areas.
Yeah, completely agree with you there. Steve St Angelo from the SRSRocco Report.com. We thank you for your time. We thank you for your work, and I hope we can do this again soon.
Yes, thank you very much, Patrick.
That was Steve St Angelo from the SRSRocco Report, sharing his views on energy and precious metals. To find more of Steve's work, please visit www.srsroccoreport.com and at SRSRocco Report on Twitter. If you like this video, please do subscribe and give it a thumbs up. Audio-only versions can be found on iTunes and Spotify.